Hey everybody, let's talk about rising foreclosures that are happening right now and early stage delinquencies in the housing market. It's important to understand this cycle and other cycles in real estate so you know when to enter and when to exit. Sometimes maybe it's your personal residence or it's rental properties. So let's dive right in. If you have been hearing the news lately about rising foreclosures or increasing delinquencies, it sounds alarming, or it can, especially if you are new to the housing market or finance. But I'm going to show you in this video, and I'm going to explain what these terms mean, why they matter, and what they signal about the economy. So let's start right with the basics. A delinquency happens when someone misses a payment on a loan, usually a mortgage, credit card, or an auto loan. An early stage delinquency means the payment is only slightly late, right? Often 30 days past due. This is the earliest warning sign that a borrower may be struggling. Foreclosure or repossession is the later step in that process. But let's focus on the foreclosure because mortgages is where everybody watches, right? Foreclosure occurs when missed payments continue and the lender begins the legal action to take back the property. Foreclosures do not happen overnight. They are the end result of months and sometimes years of missed payments. This is why early stage delinquencies matter so much. They act like a canary in the coal mine. When early delinquencies rise, it often means financial stress is spreading before foreclosures become visible. So now we need to understand why delinquencies start to rise. One common reason is higher living costs, like we're experiencing now. Higher interest rates, higher insurance, higher everything. Food, utilities becoming more expensive. Households have less room in their budgets. Something eventually gets delayed or missed. Another reason is those higher rates, right? Like we've seen in those last couple of years. I already hit on it, but it's important to understand how interest rates affect homes because we didn't have the inflation in the mid 2000s that we do today, but we had the exact same mortgage rates going up, and it caused a lot of people to stop making their payments, right? When rates rise, variable rate loans and new loans become more expensive and less people buy homes, right? Monthly payments increase even if the income stays the same. Job instability is another factor. Even small disruptions in income around the country can create missed payments, layoffs, reduced hours, or gig work slowdowns that often show up first as early delinquencies. So let's talk about why foreclosures lag behind. Lenders do not want to foreclose on their clients. It's expensive, time-consuming, and uncertain. Most lenders prefer working out a loan, forbearance, or repayment plans. This delays the foreclosure process because it also makes their shareholders not happy, right? As a result, you may see delinquencies rise long before foreclosures increase, which is happening right now. This time gap is very important for you to understand. It means the data you see today reflects the stress that started months earlier. It also means conditions can improve or worsen before foreclosures peak. So let's address a common misunderstanding. Rising early stage delinquencies do not automatically mean a housing crash is coming. They indicate pressure, not a collapse. How serious the outcome becomes depends on jobs, wages, policy responses, and borrower behavior. Another important concept is distribution. Not all borrowers are affected equally when this happens. Some areas or loan types or income groups experience stress earlier than others. This is why national averages can hide local problems. And here's an important takeaway. Early stage delinquencies are a warning signal, not a conclusion. They show where stress is forming in the system. Foreclosures are the visible outcome if the stress is not relieved. Understanding this progression helps you interpret headlines calmly. And instead of reacting emotionally, you learn how to watch trends and timings. For homeowners, awareness encourages budgeting and early action. And for investors, it highlights where opportunities or risks may develop later. Rising foreclosures never begin with foreclosure notices. They begin quietly with missed payments. Once you understand that sequence, economic news becomes less confusing and far more useful. Look, if you want to learn more about real estate cycles and where we're at today, and if you want to learn about possibly becoming a real estate investor, I'll tell you what, I will set up a package of 4 courses for the most insanely low price. Links down below. It starts with real estate cycles and so much more, all in one, to give you an idea of what's coming, how you can profit from it, and get you really set up on a path to moving forward as a real estate entrepreneur. I hope you got something out of this. Have a great day.